Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, we're unpacking the second quarter 2025 results from Realty Income. You probably know them, the monthly Dividend Company.
That's right. Our goal here is to really dig into their latest earnings call, pull out the key insights, and give you a clear picture of what's happening with this net lease giant.
Exactly. No fluff, just the important stuff. So let's start with the headline numbers for Q2.
Okay.
All right, so GAAP EPS, that came in at $0.22. Adjusted funds from operations, the AFFO number everyone watches, was $1.05.
Right. AFFO being that key cash flow metric for REITs.
Precisely. And total revenue for the quarter landed at a pretty substantial $1.41 billion.
And that revenue figure is where things get interesting right off the bat. It actually beat expectations by a good $70 million. That's also up, 5.2% year over year.
A healthy jump, yeah.
Very healthy. Now, the GAAP EPS and the AFFO were technically slight misses against consensus just by a couple of cents, but the market reaction, that was quite telling.
What did you see there?
Well, the share price actually ticked up a bit, and the after-hours trading volume doubled the usual. Plus, options activity had a bullish lean. So despite those tiny misses on the bottom line, the overall feeling seems to have been pretty positive. Investors keyed in on that revenue beat, I think.
That makes sense. Strong top-line growth can definitely overshadow a minor AFFO miss sometimes. So let's dig a bit deeper. What's really driving that 5.2% revenue growth? Is it just acquisitions, or is the core portfolio strong?
It's definitely the core portfolio contributing significantly. Same-store rental revenue was up 1.7% year over year. That hit $1.17 billion.
So existing properties are pulling their weight.
Exactly. It's crucial. It shows organic growth. And operationally, things look really solid. Occupancy held firm at 98.6%. That's even slightly up from the last quarter.
Wow, 98.6%. In this environment, that's impressive. Shows the quality of their tenants and locations, I suppose.
It really does. High occupancy like that gives you confidence in the cash flow consistency.
Okay, and they were active on the investment front too, right? How much did they deploy?
They invested a hefty $1.2 billion in the quarter.
And the returns, what kind of yields were they getting?
Pretty attractive, actually. A 7.2% weighted average initial cash yield on those investments. So for every dollar put in, they're getting 7.2 cents back in cash rent in the first year. That's strong.
Especially considering the current interest rate climate.
Mm-hmm.
And liquidity. Are they sitting on enough cash?
Oh, yeah. Liquidity remains robust, about $5.4 billion available. Plenty of flexibility there. And here's another number that jumped out at me, the rent recapture rate.
Yes, always a key indicator. What was it?
Across 346 leases they dealt with, it was 103.4%.
Over 100%. Can you quickly break down what that means for our listeners?
Sure. So a recapture rate tells you how the new rent compares to the old rent on expiring leases. Over 100%, 103.4% in this case means when leases were renewed or released to new tenants, they actually got more rent than before, about 3.4% more on average.
So rents on expiring leases are actually stepping up on average. That's a very strong sign.
It absolutely is. Shows strong demand for their spaces, good negotiating power, and sticky tenants. And renewals were dominant. 93% of their leasing activity this quarter was renewals. Stability.
Okay, powerful operational metrics.
Yeah.
So given this strength, what's management saying? What's the strategy? And what are they guiding for the rest of the year?
Well, management is definitely framing their strategy around some big global shifts. The CEO talked about positioning the platform for durable, income-oriented investment solutions, and he really emphasized the accelerating asset-light trend.
The idea that companies want to sell their real estate and lease it back.
Exactly. More companies freeing up capital by selling buildings to specialists like Realty Income, that creates a huge growing pipeline for them. And based on this, they actually nudged up their full year 2025 AFFO guidance.
Oh, really? What's the new range?
They tightened it upwards slightly. The new range is $4.24 to $4.28 per share. It was $4.22 to $4.28 before, so they raised the bottom end.
Signaling confidence in hitting at least that higher floor.
Right. It implies mid-single-digit growth year over year, and crucially, plenty of coverage for that monthly dividend. They also boosted their 2025 investment target to around $5 billion.
So they're planning to deploy even more capital.
Yep. Shows continued appetite for deals. Plus, they mentioned the big Spirit Realty merger integration. That $9.3 billion deal is firmly on track. And they expanded their credit facility, too, up to $5.38 billion. More firepower.
Seems like they're gearing up. And a lot of that firepower seems aimed overseas, particularly Europe. That was a big theme, wasn't it? This
Yeah.
geographic arbitrage idea.
A huge theme. This is really interesting. Get this. 76% of their Q2 investments, that's $889 million, went into Europe.
The 76%, wow.
And at an even better yield than their overall average for the quarter, 7.3% initial cash yield in Europe. Europe's now 17% of their total annual rent.
So it's significant and deliberate shift.
Yeah.
What kind of deals are they doing there?
Well, they just entered their 8th European country, Poland. They did a sale-leaseback with a big manufacturer, Eko Okna, and also invested in a grocery store operator there.
Could you just quickly remind folks what a sale-leaseback is? Why is it attractive for them in a place like Poland?
Sure thing. A company owns its building, say a factory. It sells that building to Realty Income, gets cash. Then it immediately signs a long-term lease to stay in that same building. The company gets capital off its balance sheet to reinvest in its main business. Realty Income gets a good property with a long-term tenant locked in. Predictable income.
Got it. And why the big push into Europe now?
Several reasons. One, the competition is more fragmented over there than in the U.S. Fewer big players chasing deals. Two, the total market size, the sheer amount of potential property, is actually larger than the U.S. And three, critically, the cost of borrowing in euros is significantly lower than borrowing in U.S. dollars right now.
Ah, the arbitrage. Borrow cheaper there, invest there, good yields.
Bingo. Borrow cheaper, invest at 7.3% yields, capture that wider spread. It's a smart financial play alongside the real estate play.
Makes sense. But expanding, especially internationally, brings risks. How are they managing tenant risk, potential defaults?
They seem pretty on top of it. Their internal credit watch list is at 4.6% of annual rent, which sounds like a chunk, but the key is diversification.
Oh, so.
The median exposure to any single client on that watch list is tiny, just 3 basis points. That's 0.03%. So very spread out risk. They are budgeting for potential rent loss in 2025 up to 75 basis points, or 0.75%, which includes potential impacts from things like tariffs, but they feel that's well covered by their watch list and diversification.
So they're acknowledging the risk and planning for it.
Yes, and they also highlighted successes. They had a 94% recapture rate on a portfolio of ZIPS properties they took back, meaning they've released almost all of it successfully, and they expect good outcomes from the at-home bankruptcy situation, too. Proactive asset management.
Okay, it sounds like disciplined risk management. Now, you mentioned they boosted their investment target. Did they talk about deal flow? Are they seeing enough opportunities?
Enough. They sourced an absolutely staggering amount. In Q2 alone, they looked at $43 billion worth of potential deals.
$43 billion in
Yep.
one quarter.
Yep. That matches their entire deal sourcing volume for all of 2024. It's the highest quarterly volume they've ever had. Year to date, they're at $66 billion sourced. Just massive deal flow.
Incredible. But are they just buying everything then?
Not at all. This is the flip side, extreme discipline. Despite seeing $43 billion of deals, their selectivity ratio was less than 3%. They passed on the vast majority.
Less than 3%.
Yeah. They specifically said they walked away from $3.7 billion worth of deals in Q2 just because the initial yields weren't high enough for their public equity cost of capital.
That's fascinating. Turning down almost $4 billion in deals.
Yeah.
And doesn't that tie into their new strategy, these new growth areas like private capital?
Exactly. This is a really key strategic development. Management sees two huge trends: aging populations needing steady income, and companies wanting asset-light balance sheets via sale leasebacks. So they're launching adjacent businesses, private capital and credit investments. They've set up an evergreen U.S. Core Plus fund. Basically, they want to use their platform and expertise to manage real estate for other investors, for third parties, become an asset manager too.
Okay, so leveraging their existing machine and those deals they passed on.
Those $3.7 billion in deals they turned down for their main REIT balance sheet. They're perfect candidates for these new private capital funds. The yields might be a bit low for the public REIT today, but they can offer great long-term returns, strong IRRs for a private fund structure with different return requirements.
So they can still capture value from those deals, just through a different pocket. It expands their universe.
Precisely. It lets them monetize their platform more fully and play in different parts of the capital stack. It's quite sophisticated.
So they're becoming more than just a landlord. How's the balance sheet holding up with all this activity?
Still looking very solid. They ended the quarter with net debt to EBITDA right at 5.5 times. That's their target level, so good discipline there.
And funding future deals.
They've been tapping their ATM program, raised $632 million in equity that way. Plus, they have about $654 million in unsettled forward equity lined up. So a good runway for funding those investments. And they also mentioned their hedging strategy for foreign exchange risk.
Right, to manage the impact of currency fluctuations from that big European push.
Exactly. They're very disciplined about hedging, so they don't really talk about FX headwinds or tailwinds in their results. It smooths things out and keeps the focus on operations.
Okay, so let's pull this all together. Thinking about the investor listening to this, what's the big picture takeaway from this quarter? How does Realty Income stack up?
Well, like we said, the market reaction was subtly positive. The revenue beat and raised guidance seemed to resonate more than the small AFFO miss.
Huh.
That fits the narrative that demand for their kind of assets is holding up well, even with macro uncertainty.
And performance-wise?
Year to date, they've done quite well. Total return of about 10.7%, which is significantly better than the broader REIT sector's 4.3%. Over 12 months, more in line. They've benefited from closing the Spirit deal and, of course, that relentless monthly dividend growth, 111 hikes in a row now. That branding is powerful.
It really is. And are competitors seeing similar strength?
Generally, yes. Other net lease peers are also guiding upwards, which suggests the sector as a whole is proving resilient.
Okay. Looking ahead, what are the potential catalysts investors should keep an eye on?
A few things. More synergies from the Spirit integration could provide a boost by Q4. There's talk of potentially signing another big European sale leaseback, maybe around $1 billion. That would be a big validation. If they continue to bring leverage down slightly below 5.5 times, that could trigger a credit rating upgrade, which lowers borrowing costs.
Cheaper capital, always good.
Always good. And then there's the Investor Day in September. Expect a lot more detail than on the private capital strategy. That could be a big one.
And valuation, where does it stand?
It's trading around a 6.3% implied cap rate right now. If the Fed starts signaling rate cuts, or if we get more confirmation that those European investment yields are staying strong above 7%, you could see the stock re-rate higher, maybe back towards the mid-$60 where it was before rates took off.
Makes sense. One last point on strategy. All this private capital money flowing into net lease from big players like Blackstone, Starwood. Is that a threat?
Management actually frames it as a positive, a win-win. They undo their decades of experience, their underwriting discipline, their A credit rating, and now their ability to offer different kinds of capital, public, REIT, equity, private funds makes them a unique partner.
So they can collaborate rather than just compete.
That's the idea. They can handle huge, complex deals that smaller players can't. They see themselves as the go-to long-term institutional owner in this space. Their scale and platform are major advantages, maybe even more so now with these new capital verticals.
A compelling argument. Okay, let's shift gears. It's time for our signature segment. This is not financial advice. We cook up an outrageous but plausible trade idea based on our deep dive. Remember, everyone, purely for entertainment and to get you thinking. What have you got for us today?
All right, here's my pitch. Let's call it the global arbitrage and platform monetization play.
Okay, intrigued.
The trade is go long Realty Income common stock, ticker O. Pair that with a short position in a basket of smaller, highly levered, mainly U.S.-focused industrial REITs. If you could find a specific inverse ETF for that niche, even better. But a basket works.
Long Realty Income, short smaller U.S. industrial REITs. What's the thesis?
It builds directly on everything we discussed. First, the global arbitrage. Realty Income's ability to borrow cheaper in euros and deploy that capital into higher-yielding European assets, like we saw with 76% of Q2 investment going there at 7.3% yields, gives them a structural margin advantage that U.S.-only REITs just don't have.
Right, the cost of capital advantage.
Exactly. Second, the platform monetization. They're not just a REIT anymore, they're becoming an asset manager via their new private capital funds. And crucially, those billions in deals they passed on for the public REIT. That's the pipeline for the private funds. They can capture value across a wider spectrum of deals now, leveraging their sourcing and underwriting machine in a way others can't. They turn potential dilution into a new revenue stream.
So it's a bet on their unique structure and strategy.
It's more than that. It's a bet on divergence. In a higher for longer rate world, scale, global reach, balance sheet strength, and diverse capital solutions become critical differentiators. Realty Income has all of those. Smaller, highly levered domestic players will likely face more stress. They can't access cheap euro debt. They don't have the private capital arm to scoop up deals that don't meet public hurdles. So this trade is a bet that Realty Income's multifaceted platform provides insurmountable competitive moats, allowing them to thrive while weaker players struggle. It's a play on the platform value, not just the property portfolio value.
A divergence play based on platform strength and global reach. That is definitely plausible, if perhaps a bit bold. Okay, let's wrap things up.
Sounds good.
So to recap, Realty Income's Q2 showed really strong operational performance, impressive consistency. We saw that clear strategic shift towards Europe, capitalizing on that cost of capital arbitrage and this exciting new push into private capital to really leverage their platform.
Yeah, and all that leading to raised AFFO guidance, which is key. They're navigating the macro challenges pretty effectively, it seems.
Absolutely. Disciplined investing, strong balance sheet, clear strategy. They seem well positioned.
They're definitely making smart moves, adapting to where they see the opportunities globally and in the capital markets. It really solidifies their competitive advantage.
Well, we hope this deep dive gave you some valuable insights and maybe some new ways to think about Realty Income and the net lease space. As always, we encourage you to do your own homework on everything we discussed today.
Definitely.
Thanks for joining us on the deep dive. We'll catch you on the next one.